Credit scores. Your credit score is a 3-digit number that controls your entire financial life. Bad credit on a $25,000 car loan, you'll pay $500 monthly. Good credit on the same loan, $300 monthly. That's $200 extra every month, just because of 3 digits on a report. 5 things determine your score. Payment history is 35%. Pay on time every time. One late payment can drop your score 50 points and stay on your report for 7 years. Credit utilization is 30%. Never use more than 30% of your available credit. If you have a $1,000 limit, never carry more than $300. Credit age is 15%. Keep old accounts open. That first credit card you got in college, don't close it. Even if you never use it, it's building your credit history. Credit mix is 10%. Have different types of credit like cards, auto loans, maybe a mortgage. New credit is 10%. Don't apply for everything at once because each application temporarily lowers your score. Below 580 score? You're a walking red flag. Above 750? You're financial royalty. You get the best rates, highest limits, and premium treatment. Compound interest. Meet Sarah and Mike, both 25. Sarah starts investing $200 every month. Mike says he'll start when he's 35 and invest $400 monthly to catch up. Who ends up with more money at 65? Sarah invests for 40 years. Total contribution $96,000. Mike invests for 30 years. Total contribution $144,000. But here's the shocking part. Sarah ends up with $1.4 million. Mike? Only $800,000. Even though Mike contributed $48,000 more than Sarah. This is compound interest, earning money on your money, then earning money on that money. Year 1, your $1,000 grows to $1,100. Year 2, you earn interest on $1,100, not just your original $1,000. By year 30, that original $1,000 has become $17,000 without you adding a penny. Banking basics. You walk into a bank, deposit $1,000 thinking it's sitting in a vault somewhere. Wrong! That money's already gone. The bank took $900 and lent it to someone buying a jet ski. Welcome to fractional reserve banking. Banks only keep a fraction of deposits because they bet not everyone will withdraw everything at once. Unless it's 2008, when everyone tried exactly that and the whole system nearly collapsed. Banks are middlemen. They pay you 2% to hold your money, then lend it at 8%. That's 6% difference. That's how they afford those fancy marble lobbies and executive bonuses. Choose your accounts wisely. Checking accounts for daily expenses, convenient, but earn nothing. Savings accounts for emergency funds, slightly higher interest. CDs for money you won't need for months, higher rates but locked up. Credit unions are member-owned, so they typically offer better rates and lower fees than big banks. Inflation. Remember when gas was under $2? When movie tickets cost $5? When you could buy a house for $50,000? That's inflation. Your money slowly becoming worth less over time. Not worthless, just worth less. Inflation averages 3% annually. Doesn't sound like much, but your money loses half its purchasing power every 23 years. 3 main causes. Too much money chasing too few goods, supply chain problems making production expensive, and expectations. If people think prices will rise, they spend now, driving prices up faster. It's a self-fulfilling prophecy. This is why keeping all your money in savings accounts is actually losing money. If your savings pays 1%, but inflation is 3%, you're losing 2% of purchasing power every year. Stock market fundamentals. When you buy a stock, you're not gambling. You're buying a tiny piece of a real company. Own Apple stock? You own a microscopic slice of every iPhone sold, every App Store purchase, every MacBook. You're literally a part owner of one of the world's most valuable companies. Stock prices move based on company performance and investor emotions. Good earnings, stock goes up. Bad news, stock goes down. The S&P 500 has averaged 10% annual returns for nearly a century. Not every year. Some years it's down 30%, others up 30%. But over decades, 10% average. This includes the Great Depression, World War II, the dot-com crash, 2008 financial crisis, and COVID. Here's what 10% average returns mean. Invest $1,000 and leave it alone for 40 years. It becomes $45,000. Invest $1,000 every year for 40 years. You end up with over $400,000 from just $40,000 in contributions. Real estate investing. Real estate gives you two ways to make money: rental income and appreciation. Buy a property for $200,000, rent it for $2,000 monthly, watch it grow in value over time. You're getting paid while your asset appreciates. Real estate's superpower is leverage. Put down $50,000, control a $250,000 property. If it appreciates 10%, you made $25,000 on your $50,000 investment. That's 50% returns through leverage. No other investment lets you borrow this much money at such low rates. But let's break down a real rental property. You buy a house for $200,000 with 20% down, so $40,000 out of pocket. Your mortgage payment is about $1,000 monthly. Property taxes, insurance, maintenance add another $500. Total costs $1,500 monthly. You rent it for $2,000 monthly. That's $500 positive cash flow, right? Wrong. You need to factor in vacancy periods when tenants move out, property management if you don't want midnight phone calls, major repairs like roofs and HVAC systems, property taxes that increase every year. Real estate isn't passive income like gurus claim. Toilets break at 2 a.m. Tenants move out, leaving damage. Markets crash and values plummet. You need significant cash reserves for maintenance and vacancies. But for those who do it right, real estate has created more millionaires than any other investment. Emergency funds. Life happens. You lose your job. Your car dies. Medical emergency hits. Your roof starts leaking. Without an emergency fund, these become financial disasters that destroy years of progress and force you into debt. Start with $1,000, then build to 3 to 6 months of expenses. If you spend $4,000 monthly, you need $12,000 to $24,000 in emergency savings. Sounds like a lot? Start small, save $50 weekly, and you'll have $2,600 in a year. Keep it in a boring savings account, earning minimal interest. This isn't an investment. It's insurance against life's curveball. You don't want your emergency fund invested in stocks when the market crashes and you lose your job simultaneously. 40% of Americans can't cover a $400 emergency without borrowing money. This means nearly half the country is one car repair away from financial disaster. Don't be part of that statistic. Market crashes. Market crashes happen every decade or so. 1929, Great Depression. 1987, Black Monday. 2000 dot-com bubble. 2008 financial crisis. 2020 COVID crash. They're not anomalies, they're features of the system. The question isn't if another crash will happen, but when. Crashes usually follow the same pattern. Prices rise beyond rational levels, driven by greed and FOMO. Everyone thinks they're a genius. Then reality hits. Panic selling begins. Prices collapse. Fortunes are lost overnight. During crashes, emotions take over. Fear drives people to sell at the bottom. But smart money? They're buying. Warren Buffett's famous advice: be fearful when others are greedy, greedy when others are fearful. When everyone else is panicking, that's when you find the best deals. Every major crash in history has been followed by recovery and new highs. Asset allocation. Don't put all your eggs in one basket. Asset allocation means spreading investments across different types. Stocks for growth, bonds for stability, real estate for inflation protection, maybe some commodities for crisis hedging. Classic rule: subtract your age from 100. That's your stock percentage. 25 years old, 75% stocks. 65 years old, 35% stocks. Younger people can handle more risk because they have time to recover from losses. When stocks crash, bonds often rise as investors seek safety. When real estate struggles, commodities might soar. When the dollar weakens, international investments gain value. Diversification doesn't guarantee profits, but it smooths the ride and reduces the chance of losing everything. 401k and retirement planning. Your 401k is the closest thing to free money you'll ever find. Many employers match contributions. Contribute $100, they add $50. That's an instant 50% return before any investment gains. Not taking the full match is literally leaving money on the table. 401ks are tax advantaged. Money goes in before taxes, reducing your current tax bill. It grows tax-free for decades. You only pay taxes when you withdraw in retirement, when you're likely in a lower tax bracket. This tax deferral can save you hundreds of thousands over a career. Max out your 401k, if possible. It's one of the best tax shelters available to regular people. Insurance types. Insurance protects your wealth from catastrophic losses. Car accident without auto insurance? You could lose everything and face lawsuits. House fire without homeowners insurance? Decades of savings gone in one night. Serious illness without health insurance. Medical bankruptcy destroys millions of families every year. Health insurance is most important. Medical costs are the leading cause of bankruptcy in America. A serious illness can cost hundreds of thousands. Heart surgery over 100,000. Cancer treatment over 500,000. Without insurance, these costs destroy any family's finances. Auto insurance is legally required in most states, but minimum coverage isn't enough. If you cause a serious accident, you could be sued for millions. Homeowners insurance protects your biggest asset and provides liability coverage if someone gets injured on your property. Disability insurance protects your ability to earn income. You're more likely to become disabled than to die during your working years. If people depend on your income, you need both life and disability insurance. Bonds and fixed income. Bonds are I O us. You lend money to governments or corporations. They pay you interest regularly and return your principal at maturity. Boring? Yes. Reliable? Usually. Essential for a balanced portfolio? Absolutely. Bond prices move opposite to interest rates. When rates rise, existing bond prices fall because new bonds pay higher rates. When rates fall, existing bond prices rise because they pay higher rates than new bonds. This inverse relationship confuses many investors. Government bonds are backed by the full faith and credit of the issuing government. US Treasury bonds are considered the safest investments in the world because the US has never defaulted, but safety comes with low returns. Corporate bonds pay higher interest because companies can go bankrupt. Municipal bonds are issued by state and local governments. The interest is often tax-free at the federal level and sometimes state level too. For people in high tax brackets, the after-tax return on municipal bonds can be higher than taxable bonds. Bonds provide stability and income in a portfolio. When stocks crash, bonds often rise as investors seek safety. Retirees often increase their bond allocation to generate steady income without stock market volatility. Dollar cost averaging. Dollar cost averaging means investing the same amount regularly, regardless of market conditions. $500 monthly, whether the market's up, down, or sideways. This removes emotion and timing from investing. When prices are low, your 500 buys more shares. When prices are high, it buys fewer shares. Over time, you average out market volatility and typically get a better average price than trying to time the market. Investment apps and platforms. Investing used to require calling a broker and paying $50 per trade. You needed thousands to start. Now you can buy stocks, commission-free from your phone while waiting for coffee. Different platforms serve different needs. Robinhood appeals to young investors with its simple interface. Fidelity and Schwab offer comprehensive services. Vanguard focuses on low-cost index funds. Choose based on your investing style and experience level. Always check fees, even on free platforms. Commission-free stock trades are common, but platforms make money through other fees. Account maintenance, wire transfers, margin interest, and payment for order flow can add up over time. Risk versus return. Higher potential returns require higher risk. This is the fundamental law of investing. Savings accounts are safe, but earn almost nothing after inflation. Stocks are riskier, but historically return more. Cryptocurrency is extremely risky, but offers massive potential gains or losses. Your risk tolerance should match your time horizon. 25 years old with 40 years until retirement, you can handle stock market volatility because you have time to recover from crashes. 65 and retiring next year, preserve capital, don't chase returns. But risk tolerance is also psychological. Some people can't sleep if their portfolio drops 10%. Others can handle 50% drops without panicking. Know yourself and invest accordingly. The best investment strategy is one you can stick with through good times and bad. Diversification reduces risk without reducing expected returns. Instead of buying one stock, buy hundreds through index funds. Instead of investing only in US stocks, add international exposure. Instead of only stocks, add bonds and real estate. Economic indicators. Economic indicators are like financial weather reports. They tell you what's happening in the economy and help predict what might happen next. GDP measures total economic output. Unemployment shows job market health. Inflation measures price increases. Interest rates affect borrowing costs. These indicators affect your investments in predictable ways. Rising interest rates typically hurt bond prices and growth stocks because higher rates make bonds more attractive and increase borrowing costs for companies. Low unemployment usually boosts consumer spending and stock prices. Leading indicators predict future economic activity. The stock market is a leading indicator because it often predicts recessions 6 to 9 months in advance. Lagging indicators confirm what already happened. Unemployment is a lagging indicator because companies don't lay off workers until after business slows. Consumer confidence measures how optimistic people feel about the economy. High confidence leads to more spending, which drives economic growth. Low confidence can become self-fulfilling as people spend less and slow the economy. Don't try to time the market based on economic indicators. Professional economists with access to all the data still can't predict market movements consistently. Use indicators to understand the economic environment, but stick to your long-term investment strategy. Tax strategies. Taxes are your largest lifetime expense. The average American pays more in taxes than housing, food, and transportation combined. Smart tax strategies can save hundreds of thousands over a lifetime, but most people ignore this massive opportunity. Use tax-advantaged accounts first, before investing in taxable accounts. 401k contributions reduce current taxes. Traditional IRA contributions might be deductible depending on your income. Roth IRA contributions aren't deductible but grow tax-free forever. Health savings accounts offer triple tax advantages. Contributions are deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. After age 65, you can withdraw for any purpose and only pay regular income taxes, making HSAs like super IRAs. Tax loss harvesting involves selling losing investments to offset gains from winning investments. If you made $5,000 on Apple stock but lost $3,000 on Tesla stock, you only owe taxes on the $2,000 net gain. This strategy can save thousands annually.
Financial psychology.
Your brain isn't wired for good financial decisions. We evolved to survive immediate threats, not optimize long-term wealth. This creates predictable psychological biases that destroy returns and keep people poor despite good intentions. The best investment you can make is in your financial education. Knowledge compounds just like money. Stay educated and disciplined. Markets will crash, economies will struggle, and your emotions will try to sabotage your progress. But if you understand these fundamental concepts and stick to proven strategies, you'll build wealth steadily over time. If this video just saved you from making expensive financial mistakes, smash that like button. Seriously, it helps more people discover this content and build wealth. And if you want more videos breaking down complex finance topics into simple explanations, hit that subscribe button and ring the notification bell. Pick one concept from this video, just one. Don't be the person who watches every finance video but never takes action. Be the person who actually builds wealth. Start today, start small, but start.